New leadership, new tax policies. What does it mean to you and what you can do about it? I'm Eric Brenner. Join me right now for Your Wealth Health. Hello and welcome to Your Wealth Health. I'm Eric Brenner, owner of Hilltop Wealth Solutions, and I'm joining you from our office in Fort Myers, Florida today. Thanks for joining us today. And if you're watching us on Facebook, please share us with someone that you could think that may use the information. And we also want to thank those that are watching us on yourwealthhealth.com. Joining me today is Bill Davis. He's a private wealth advisor for Hilltop Wealth Solutions. And Matt Arenz, our director of wealth management. Both are in their homes as we continue to practice safety protocols during this pandemic. Well, we now have a new president and a new administration. Joe Biden was sworn into office 3 days ago and becomes our 46th president. And after the Democrats won the 2 Senate seats in Georgia runoff elections, President Biden will have a majority in both the Senate and the House. Changes are likely, especially tax policies. So we're going to address those issues. We're going to dig into them today and policies that may impact you and which ones will not. The first one we want to really talk about is individual tax rates. If all goes well, and the most of us will not see an increase on their tax rates. And Bill, a lot of people think that it may impact them, but we really need to take a look at first historically what are tax rates and maybe some things to think about in this new Biden policy.
Yeah, thanks, Eric. And just as he ran on, it appears that the proposals will be to increase the ordinary income tax on people over that have a household taxable income over $400,000. But really, what we're going to outline on this show today is we think that's really the opportunity set for people to go into additional tax planning opportunities, because it's likely, and it's been confirmed by some of our partners, Westbury at First Trust and people like that, that the tax changes are not likely to go into effect for the 2021 tax year. And so that's really the opportunity time that we have, is to start working on the taking advantage of those things that are going to change that are outside of the $400,000 income tax bracket. And so that's really what we're set up to talk about on today's show.
Yeah, so really, Matt, what we're talking about here is the Biden proposal is talking about individual tax rates affecting those that make $400,000 or more. So that it may not affect a lot of people.
You're right. I don't think it'll affect as many people as you would see. I don't know all that many people who make $400,000 or more, but it will definitely influence quite a number of people. And I think that they're going to have to just take a look at how does that actually influence the money that we have left over at the end of every month? Savings rates. What would that tax rate look like? And for the people, to Bill's point, who are under the 400,000, it's really beginning to take advantage of what opportunities exist in the current tax code, but the 400,000 more. What opportunities exist today in 2021 that will allow me to maximize my tax bracket, tax strategies, tax savings? Because if those change going forward, which they likely will, they're going to lose a lot of benefits, and that's going to hinder their long-term success when it comes to taxes.
Yeah, that's a good point. So if we take a look at this graphic, it shows historically tax rates and where they're at, breaking down kind of individual income and payroll tax, individual income, and we can see that back in the 80s, we peaked out there as it relates to our tax rates. And, dropped off quite substantially. Then it kind of increased, dropped off again. And we've had some ups and downs. Of course, in 2016, we had some tax changes and it came down. And then it's projected really to go up. And Bill, 40-year tax lows. And what we really wanted to do was show people that even over the last 10 years, from 2010 to 2020, the next graphic shows that the brackets have gotten less. There's less kind of brackets to hit, and they've gotten a lot wider. And so there's a lot more planning opportunity right now than even there was in 2010.
Yeah, absolutely, Eric. This is really a key graphic for our listeners today, is to think that if you made just $200,000 in your household, Once you broke that 209,000, you were paying 32% tax bracket, and you don't hit that till 327,000 under today's rules. And so we just think the sweet spot for the tax planning is those households that are earning under the 400,000. And because you can see that under 400,000, the existing tax rate's 32. And again, that's the marginal rate. That isn't the effective rate of what people are paying. And so the proposal is to go back to, pre-2010 type numbers, which is now going to and actually move the top rate up to 39%. So, prior to that happening is going to be the opportunity to think about Roth conversions. If you're able to control your small business income, can is that an opportunity to move money over to 2022 from 2021? There's just lots of things that we need to talk about once we get kind of done with the 2020 tax return. That's a perfect document to use as to guide for some 2021 tax planning, because we just don't think that it's going to be possible for the new administration to get a new tax law through to apply to the 2021 tax year.
Yeah, possible, and really timing wise with the global pandemic going on and so forth. So on this graphic here that I want to reference again, so we often see where folks fall in that, right in the middle of maybe the 22% bracket, and we call it maximizing tax brackets, Matt. So we say, if someone falls into 120,000, they've got from 120 to 171 before they jump up. And, those are opportunities to really maybe maximize brackets now. And, all of this is, this planning is around where our viewers feel their taxes are going. If they do feel like they're going to go up and the rates are going to go up, now, having some strategy now and tax-free money down the road is certainly going to be advantageous.
Without a question. And I think that's the whole game plan here, is to really say we don't know exactly, but I think most viewers would say taxes are going to go up. And there's a lot of other anomalies that are out there, right? You could get bonuses, you could have a random windfall, it could be an inheritance, something of that nature, and some tax law changes have occurred there for inheritances. And so how do you structure, if you're in a phase where you're taking out required distributions from an inherited IRA, and it has to be depleted within 10 years, you might want to think about, should I take more money out this year as opposed to next year, because the uncertainty of what those tax brackets will look like. And if I have IRA money and I was unemployed for 6 months this year, should I look at, doing a Roth conversion this year while my income is lower? So just all of those things, it's better to plan ahead and really take control of your taxes, as opposed to planning at the end of the year and being very reactive and just waiting to see what happens.
Yep. Great. Thanks. So Bill, corporate tax rates. Now this does appear that in the proposal, at least what's been talked about. And of course, we're going to find out more here as we progress throughout the year. But, we've seen based on this graphic that we have some pretty high corporate rates back in the 60s and 70s. And, that dropped. But it appears that those rates are going to change for corporations.
Yeah, exactly, Eric. The proposal right now is to take the corporate tax rate from 21 to 28. And so that's a pretty significant jump. But in addition, it was really interesting to read about, they're talking about a 15% minimum book tax. We currently don't have a minimum book tax under the current tax code. And so that could be a pretty significant factor on corporate taxes. Corporations have been pretty good at managing taxes by managing deductible expenses and things like that, payrolls. But there could be some significant jumps in payroll taxes as well for the group that's over 400,000. So there's a lot of things to manage for our C corporations as it relates to their corporate income taxes, depending on what the proposal actually comes to fruition.
Thanks, Bill. Now, another thing quickly, Matt, is the child tax credit. You probably heard of it, going from 2,000 to 3,000. And of course, there could be some folks out there that would benefit from that.
Oh, without a doubt. The more children you have, the more the credit goes up. And so there is that $2,000 to $3,000 for anybody under the age of 17. And then there's also, if you're under the age of 6, even looking at getting an additional boost of about $600 per child. So that could be a big swing for some people, and that might, make them pay attention to, should I save money into a Roth or should I save money into a 401k, and those types of tax strategies based on the number of dependents they have in their household.
Great. Thanks. Well, we all know tax issues can be complicated, and many of you are starting to think about your taxes. Your W-2s, 1099s are going to be arriving, and you're starting to get organized, and you don't want to wait until the last minute. Well, we can help you with your taxes. We have a firm, Hilltop Tax Solutions, and we offer tax planning and tax preparation for individuals and businesses. And right now, you can get 20% discount on tax returns if you respond before March. So we're offering this also accounting and bookkeeping services at a discount for small businesses. And that is at 10% discount for an entire year. So you can go to our website at hilltoptax.com, or you can call the number on your screen. Call that number and let them know you want to take advantage of the discount, and we can help you with all of your tax preparation. Still to come on Your Wealth Health, more on the potential impact on President Biden's proposed tax plans. What will impact be on estate planning? Stay with us. Welcome back to Your Wealth Health. I'm Eric Renner, owner of Hilltop Wealth Solutions, and I'm joined by private wealth advisor Bill Davis and our director of wealth management, Matt Arenz. And we're discussing today proposed tax changes under the new administration in our country. Since President Biden is now in office, there's going to be some changes. And we're not saying these policies are good or bad. We're just making you aware of the possibilities. And one of the biggest changes that's going to affect a lot of people is the proposal to eliminate stepped up basis for capital gains. This is not a done deal, of course, but the Tax Foundation has it listed as a likely policy change. So, Bill, this could affect a lot of individuals.
Yeah, I want to first kind of give a little explanation of what we're talking about here. So the basis is the amount that you invested in whatever, your home, your investment property, your child's uniform gift to minors act, any investment that you made with after-tax dollars, that's the established basis. So over the years, it grows. And so, many times this involves, we think the biggest impact is going to be on our landowners, our farmers that have significant wealth accumulation in their properties. So, you could have a property that was purchased for $1,000 that's now worth $10,000 an acre. So under the current laws, you can pass that to the next generation. It'll step up from the 1,000 to the 10,000. The beneficiaries could sell the property, which isn't always common, but they could sell the property and there would be no tax. So you would avoid that whole $9,000 per acre in tax. Well, the administration's discussion is around eliminating that step up. So it could eliminate step up on real estate investments, farm properties, individual investments. I mean, there's lots of things that, people, grandpa bought IBM stock back in the 40s and he wants to pass it on to his next generation at no tax. Well, those kinds of things are going to go away. And so we need to look at the current tax, capital gains tax is the lowest it's ever been. So now we might want to liquidate some of these assets and take advantage of today's capital gains rates.
Yeah, that was a good explanation, Bill. And as long as I've been an advisor, we've been talking about they haven't touched this stepped up basis yet. But at least it's in the initial proposal that there may be some changes there. The other thing that could be a big deal is to help avoid capital gains is what's called a 1031 exchange, property exchange. So Matt, maybe explain that a little bit for our viewers and that also could be eliminated.
Yeah, you're exactly right, Eric. So a 1031 exchange is really just the ability to transfer the capital gains from one like property to a next. So you're really just deferring paying the capital gains tax on your growth of that appreciated asset, and it's really in real estate. So, for example, let's say you have a lake house, and it was you inherited this lake house, and it's the family house, and you decide, I want to sell it and I want to buy a new lake property, and you bought that lake property, you inherited it at 200,000. 15 years later, you sell it and it's worth 700,000, and there's $500 in capital gains tax. Well, what you can do is just transfer it to the new lake property and defer that taxability. And this proposal would essentially say that's no longer allowed. We're going to eliminate that. You're welcome to buy that new property, but after you sell your existing one, pay the tax and then purchase the new property. And so what you can see is that taxability would actually reduce your purchasing power, because by the time you pay the tax, the net amount to buy that new piece of property is diminished. And so it's really just it's creating tax revenue for the government while people buy and sell within like type properties. And you could see this in rental properties. You could see it, to Bill's point, in farmland. There's just a lot of different property transactions that people will have, and it's not allowing you to continue to defer those gains. You're going to have to pay the tax upon transactions.
So thanks, Matt. So also another thing that I wanted to talk about was the federal exemption, estate tax exemption. So right now, Bill, an individual can pass on assets, and before it hits the federal estate brackets, they can pass on 11.7 million. So if you have a couple combined and they do proper estate planning, that's over 23 million. And the proposal is to move that federal estate tax exemption down to 2009 levels, 3.5 million. So, it's still millions. So a lot of people may say, hey, that doesn't really affect me. But, your life insurance, death benefit, all of your assets combined, equals what your estate is. And so, this is also a big pullback in the federal estate exemption.
Right. I think we're going to have to revisit if the proposal does move us down to $3.5 million exemption, which would include gift taxing as well. So if you've been, having to do any gifting of your estate over the last several years, it would affect that as well. But we may be back to looking at, trust. What are the kinds of trust provisions that we put into the estate plan? And all of a sudden, the next thing you know, you're at those numbers, and we haven't worried about it for a while for most of the clients that we do planning for. But I think it's all taxes are back on the table now. I did want to throw one more thing out about that capital gains issue, because that could apply to this as well. You might look at trying to gift some assets out of your estate that are highly appreciated, and we might be looking at some charitable gifting again, or some charitable remainder trusts, and we haven't used a lot of those for the years. But that's, I think, back on the table now when it was off, because they're talking about taking the capital gains rate to the top rate of 39.6 for people over $1 million in income.
Yeah, it appears that some of those planning strategies that maybe weren't, or haven't been used the last few years now, as you said, Bill, may apply. So a lot to think about. And, we understand that this is a time that many of you are also starting to think about just taxes preparation. It's tax time. now we're into a new year and you're getting all your information, or will begin to get all your information. And Hilltop Tax Solutions offers tax planning and tax preparation for individuals and businesses. And right now you can get a 20% discount on your tax returns, and you need to respond by March. So we also offer accounting and bookkeeping services for small businesses, and are offering a 10% discount on those services. So you can sign up at our website, hilltoptax.com, or you can call us at the number on your screen. There was new legislation passed in the beginning of 2020 that could have an impact on you and your estate plan. It was known as the Secure Act, and we'll review it when we come back on Your Wealth Health. Welcome back to Your Wealth Health. I'm Eric Brenner, along with Bill Davis and Matt Arenz, and we've been talking about potential tax policy changes that could impact your financial situation. And we wanted to talk about a law that fits into this discussion. It went into effect beginning of 2020, and that's called the Secure Act. So, we talked about that in this format. We've talked about it with a lot of our clients over the last little over a year, Bill. And, there's a lot in here, and this comes into this planning that we've been talking about, including that they moved the required minimum distribution date when you need to draw from your IRA from 70.5 to 72.
Yeah, Eric, that's a great planning opportunity that a lot of people have overlooked. That now they don't have to start their required minimum distribution till age 72. There's some pros and cons to that, right? I mean, by age 72, the IRA is going to be bigger, so therefore the required minimum distribution is going to be more because their life expectancy will be less. So that what we like about it, it gave us the opportunity to look at people in that 70, 71, 72 age range that may take the opportunity to convert to Roth, do some Roth conversions. And so it extended the time frame for us as true tax planners to help people determine whether to do a Roth conversion before the tax rates go up. And we talked on the first couple segments, we think they're going to go up, and we think they're going to go up in 2022. So this is a great opportunity.
So Matt, Bill brought up Roth conversions, and we now are seeing that we've been doing this a long time, and we're now seeing some substantial money in Roth assets, and it's really nice that people are able to take money, withdraw it tax free. So we're really encouraging people, if you're saving money and you have the opportunity to save some money in Roth within your plan, and then also try to have some Roth money in retirement if possible.
You're exactly right. And even looking at the ability for plans that adapted at work, which are allowing Roth provisions in 401ks, and allowing the ability to save after-tax dollars there for tax-free withdrawal and retirement. And that's, again, leading back to the child tax credits and increasing there. So if you're getting additional tax deduction there, could you push some money over from the pre-tax savings to the post-tax savings in Roth? But again, we're just saying the more money that you can get into assets that are going to grow tax deferred and be tax free later in life seems to be a pretty good solution, especially knowing that at this point, or believing that taxes are going to go up. So if you have a higher tax rate in retirement with the same amount of income, it would behoove you to have those tax free dollars and that money positioned for the retirement income to be tax free.
Another reason behind it is the elimination of the stretch IRA. So this was a big one because, we have seen again assets, people there's been saving more. They're more responsible for themselves now than ever to save for themselves. Pensions are less and less. And so these assets within these deferred accounts have grown. And Bill, now you can't stretch it out. So if you pass it on to a non-spouse beneficiary, children as an example, they can't stretch it out over a life expectancy or set up a pension. They have to have it out by the end of the 10th year. And so this is a huge thing to look at if you have deferred assets right now that are going to be passed on to non-spouse beneficiaries.
Yeah, that's correct, Eric. We have always been planning for people to take out the least amount of taxable income out of inherited IRAs, and now we have to think about how are we going to get this money out by the end of the 10th year in the most tax efficient manner, thus leading us to having annual tax planning meetings about this money. Now, I want to remind the viewers that if your loved one passed away prior to December 31st of 2019, the old stretch rules apply. If the loved one passed away in January 1st or after of 2020, now the new inherited IRA laws will be applicable to you. So if you have inherited money from a non-spouse, you need to be thinking about how you're going to, in the most tax efficient way, withdraw that money over 10 years. And I think 2021, as we've been talking about on this show, is the most important year to manage distributions of an inherited IRA.
Yeah, thanks, Bill. In fact, I had a situation where somebody inherited an IRA in 2020, and they got advice from someone else to start that withdrawal immediately to get the 10 years. And what they're going to do is retire in 2 years. So their income is going to drop substantially. So we can take the money out anytime during the 10 years. And it really they would have paid a lot more in income taxes by drawing those first 2 years out of the IRA instead of waiting. And then we're also waiting to withdraw Social Security for a bit because they can draw a lot more money out of the IRA. And so it really comes into play. So Matt and Bill, really, we think that income taxes, taxes are going to go up. Plus, we've got a lot of money out there that was necessary for this global pandemic. Individuals, certainly over 400,000 is going to affect, but stepped up basis, elimination of that. And the Secure Act is something that you could take advantage of. But Bill, we probably don't see this happening right away.
That's correct. Yeah, it's going to take some time. It's going to have to go through Congress. Even though we have a blue Congress, I think that the fiscal pandemic stimulus package is going to be a top priority, 1.9 trillion, and it'll take a while to hash that out. So I'm thinking it's going to be down the road later in the year before the Biden administration is able to get to working on the tax code.
Yep. Great, Bill. Thanks. And once again, we can help you with your tax planning and your tax preparation. Hilltop Tax Solutions offers tax planning, tax preparation for individuals and businesses. And right now you can save 20% on your tax returns if you respond before March. We also offer accounting and bookkeeping services for businesses, and we're giving you a 10% discount for the first year on those services. You can check us out on our website at hilltoptax.com or call the number on your screen and let them know that you want us to prepare your taxes. Well, that's all the time we have for today. For Bill Davis and Matt Arenz and the entire team here at Hilltop, thank you for watching this morning. We'll see you next week. Until then, stay wealthy, Michiana.